advantages. I think it might have been that they got a trip to Bermuda each year, but the offshore captives are still very big. But what's happened with the federal government over the last number of years is that they've started cracking down on offshore accounts, offshore things. The Department of Labor's passed a rule that you cannot insure certain employee benefits in a captive that's an international captive, and I've got a citation in here for that. And so most people are starting to look onshore. We saw the same thing in our trust industry. Our trust industry in South Dakota was kind of the leader in that, but a lot of people were going offshore to form trusts, asset protection trusts, things like that, and you just get a seal of good housekeeping seal of approval if you've got a domestic incorporated thing. But thank you for the question. What I wanted to get into on page 9 are what are the non-tax advantages of captive insurance, and what reasons would your client want to use to form. And again, Mark LaPointe has pointed out that there's 4 C's. Cost, coverage, capacity, and control. Because remember, we're not doing this for tax reasons. We're doing it because it's a good business decision. Here's why it's a good business decision. First of all, is the cost advantage. One cost advantage is cash flow. When I pay my homeowner's insurance, let's assume I pay my homeowner's insurance and I pay $1,000 premium each year. I pay that on January 1st each year religiously. After 10 years, I pay $10,000 in, and then I have a $10,000 loss. And they pay me back my $10,000. Might take a couple of years for them to process the claim, but eventually I get back the $10,000. But that insurance carrier has had the use of that $10,000. Throughout the time, they've had the use of $1,000 a year. They've been able to invest it. So I'm not getting back my $10,000. They've made a lot of money on that $10,000. With a captive insurance company, all of that investment income, all of that cash flow can go to the business itself. Second thing, and I've touched on this previously, is reinsurance. An individual business doesn't have access to reinsurance markets. A captive insurance company does. Now, their wholesale markets and the commercial insurance market is obviously retail. So most estimates are this can save from 10 to 20% on the premium dollar. In certain cases, some reinsurers even pay the captive a commission back, and reinsurers actually find that captives are one of the more profitable sectors of their reinsurance, and that's why they keep the rates low too. And the reason for that is because captives' risks tend to be good risks. They practice good management. The third reason is just less straight out cost. Most large insurance companies pay between 20 and 30% of their gross revenue on selling, on commissions for sales, on general administrative expenses. Captives are much leaner. We don't have to pay an insurance salesman a commission to sell us on our own captive, which we own. They've got far lower overhead, and in South Dakota, particularly in the trust captive area, which is new to our statute and unique to our statute, the administrative costs are reduced much further. And the other thing is because premiums are based on the insurer's overall perception of the risk, they fluctuate substantially based on national trends for your clients that actually may bear little resemblance to the individual risk that your clients have. When you pay a commercial premium, they figure in the overhead and the marketing, and then they use a basis normally nationally. As such, they don't rate your client specifically on your company's individual risk profile. when ALPS was formed, and a number of us remember that, there were high malpractice claims on the East and West Coast that were driving up insurance costs for people in South Dakota who'd never had legal malpractice claims. But they were rating us nationally. A captive insurance company is rated on the individual risk profile, and that can develop much lower premiums and stable pricing. So because you're focusing on a smaller number of insureds, and the insureds obviously try to control their risk, you can prevent premiums from increasing and create a more stable pricing environment. And finally, the last point is the investment income that you'll have in your captive. That's part of the capital of the insured. So that's the first advantage, the cost advantage. The second advantage is the coverage advantage. As I previously discussed, you can have tailored coverage. You can exactly match your coverage to the risk. You can broaden the terms of the risk covered. You can cover currently excluded risks. You can tailor your co-insurance participation. There are certain risks that commercial insurance won't cover at any price. I'm told that mold coverage is something you just can't get. If you're a developer, you can set aside money and write a captive insurance company that covers mold coverage. It also allows differences in conditions. I challenge each of you to go back and just read your commercial insurance general liability policy and see where risks are uncovered. One of the issues that I thought of when I was putting this presentation together, I just read an article that with the federal farm bill and all this, that they're cutting back a lot on crop insurance. Would a group of farmers be able to get together, or ranchers, and fund their own captive crop insurance company where they'd get the benefits? And the answer again is yes. I've got an article from one of the farm websites on Appendix 3 about that. This is where I put in, this will be the joke in the presentation I wanted. Larry's barn burned down and his wife Susan called the insurance company. Susan told the insurance company, "We had that barn insured for $50,000 and I want my money." Well, the agent said, "Wait a minute, Susan, insurance doesn't work like that. We will ascertain the value of what was insured and provide you with a new one of comparable worth." There was a long pause. Susan replied, "Then I'd like to cancel that life insurance policy on my husband." Thank you. What we remember when we're writing coverage like this, and you're actually writing the coverage, is that the insurance company is a contract between the insured and the insurer. And our cases are filled with disputes over coverage and disputes in that contract. If the insured and insurer are on the same side, however, you can put together coverage clauses that make sense for the business enterprise as a whole. Remember I said that most policies allow the insurer to choose its own defense counsel. Beech Aircraft has a case in the footnote on page 11 where they had got into a big dispute with, they were sued and they got into a big dispute with their insurance carrier as to who could choose defense counsel, and they didn't like the defense counsel the insurance carrier had chosen. The court ruled that you can't discharge that insurance carrier if you want to keep your coverage, and jury returned a verdict of $17 million. The next year, Beech Aircraft set up its own captive insurance company so that it could control that. And then I've got the site of the contract terms of my favorite case from Judge Friendly, Southern District of New York, 1960. Simple sales contract to sell chickens. And the parties got into a dispute over the meaning of chickens, and chickens wasn't well defined. So if you look at that case, you'll see that they went to the district court in New York, and Judge Friendly wrote a great decision on whether a chicken was a stewing chicken or a broiler or fryer. But the point of all this is that as a contract, if you're able to write the terms and you're representing your clients as the enterprise, you can be sure that things are covered that you want covered. The other problem with using commercial coverage is that they have standard terms, and again, they don't negotiate those. I used to be involved with a baseball team, and we used to have concerts at the baseball stadium. A lot of times buy rain insurance, because if you had a lot of rain in an outdoor baseball stadium, nobody was going to come to the concert, and you wouldn't sell as much beer as you thought you were going to. And so you could purchase in how much rain would fall. The problem was that the insurance policy, and they would not change this, said the rain that falls at the closest U.S. Weather Bureau weather station. And so you could have a situation where you purchase coverage for 2 inches of rain, and that they'd pay you $40,000 if 2 inches of rain fell that day in the 24 hours before the concert. But if 3 inches of rain fell at the baseball stadium and only 1.9 inches of rain fell at the U.S. weather station, you weren't collecting on that policy. Again, the point is that one of the most important advantages of a captive insurance company is you can cover and define what you've got covered for your clients. You can co-insure with your current insurance for a time, and this is what a lot of startup captives do. In other words, you don't have to completely replace commercial insurance, but you can gradually start raising the deductible and having the captive insurance company at the level that comes in. Maybe the first year you insure 20%, 40% as you build up your capital, 60%, 80% finally you replace it. Finally, you can insure other risks. The more risks you insure, it's like a casino, the better the economics than underwriting just one single line. The next advantage is the capacity advantage. And basically what this is again the layered cake. Perhaps the captive will cover the first $50,000 out of pocket, then the commercial insurance will kick in from $50,000 to $1 million, and the captive will cover $1 million to $10 million, and of that last $7 million you buy some type of reinsurance. By mixing and matching, you'll find you can save substantial dollars. Captive may permit entry to new markets later. There's a lot of times that one of your clients may need to put up certain things like bonds or coverage that it needs to have in order even to bid on certain projects. If you have a captive insurance company, that captive insurance company can underwrite the bonds probably at a much cheaper price. Additionally, with respect to the South Dakota Division of Insurance, once you go through the application process and you get your captive insurance charter and license, you don't have to go through the full application process to add on certain coverages. So once you've got the captive insurance company in place, you have the capacity to expand it. And at page 13 and 14, I want to tell you about one specific case, and I've talked to the attorney, my friend Chad Biltmore, on Biltmore Captive Insurance. This is the story that really expanded my reference point on captive insurance, because captive insurance, remember we talked about at the very beginning, it's a risk, it's risk shifting, and captive insurance doesn't just have risks that continue. Captive insurance can be written for a one-time risk. Facts of the case were that a Delaware for-profit LLC wanted to purchase a healthcare campus that consisted of a bunch of nursing homes, Alzheimer treatment facility, guest residences on site. Because it was a nonprofit that was selling, the Attorney General of the state was involved to approve the transaction. And in this state, they required that when the nonprofit sold all its assets and distributed them, that they had to go out of business. They could not keep their business alive at that point. As most of you probably know, in healthcare situations, there's a lot of Medicaid and Medicare dollars, and so of course, Bayer, the for-profit LLC, wanted an indemnity provision covering Medicaid and Medicare billing audits, because they could go back for 4 years and audit payments that had been made to the nonprofit. The annual billing was in excess of $44 million. Well, this caused a big problem with the sale. The indemnity would require the seller to either maintain its operations, which it couldn't do, get a letter of credit from a bank for $44 million a year for 4 years, which probably would have squelched the deal, or put a whole bunch of money in escrow, which again, since the nonprofit had to immediately distribute its assets, according to the Attorney General, it could not do. So what the buyer and seller did was they entered into a captive insurance solution. The buyer created a new captive insurance company which insured only the prior Medicare Medicaid risk of the seller. They had actuaries come in, they figured the potential loss, how much premium would be required to cover this tail risk under an errors and omissions policy for past Medicare and Medicaid billing claims and potential audit risk. And the seller then was able to fund a portion of the premiums for that policy. That allowed the sale to close in 30 days after contract signing and allowed the seller to cease operations by making captive insurance payments substantially less than it was talking about escrows or cash indemnity. The seller assigned the risk to the buyer, who assumed the risk but had a captive insurance company that the buyer owned to cover it. So it became a win-win situation. Without the option, the sale would not have closed. The private buyer self-insured that risk. The buyer drafted this governmental billing errors and omissions policy, claims made that would run out after 4 years. Right now they're in the 3rd year, they haven't been audited yet. The benefit of the payments of that captive insurance company have gone to the buyer. And you know, as he was telling me about that, I thought, you know, how many times have we as business lawyers been in situations where a manufacturer is sold or a business is sold and the buyer wants protection against claims that could have been made against the business after the sale? How many times have these unknown risks or escrow requirements or hold harmless held up a sale or resulted in substantial disagreements between the parties? So the question I ask is, what if you had the captive insurance solution as another arrow in your quiver to consider going down these sale paths? Well, I think that with what South Dakota did, now you've got that arrow in your quiver. Page 14, I talk about the control advantage. This is another advantage of captive insurance companies. The business controls the claims and the business controls the service providers. business then can focus its risk management efforts, such as choice of defense counsel, enhanced loss control, and determining when the claim must be reported. Wouldn't it be refreshing to have an insurance company broadly interpret a clause in favor of coverage? When the claim is paid, you're also on the same side as the insurance company, so there isn't as much delay in this case. But I think that the key control advantage is at the top of page 15, increased awareness and implementation of risk control practices. The mentality of a captive insurance company is closer to that of a risk manager than of a commercial insurer. The commercial insurer considers the risk management during the time, the 1 year that they cover the risk, where the captive insurer considers the risk management in a much longer time horizon. It's kind of like when you rent a car, and when I rent a car, I don't necessarily swerve around all the potholes, because it's a rental. I'm going to give it back. But if I own that car, I try to miss all the potholes. The other advantage, and we're going to get to the tax advantages, but the other advantage, not a C advantage, is I can figure out how to make it a C, but is asset protection. Because the captive insurer is a separate entity from the insured company, there can be asset protection advantages as well, because you place the assets in a segregated company, and especially in South Dakota, where you can place it in a trust wrapper around the which owns the shares in the captive insurer, you can get additional asset protection advantages for the business. So we've been spending a lot of time discussing advantages of captive insurance, and we haven't once touched on tax. Now I'm going to give you the tax considerations. The simplest tax consideration is this, that you learned on the first day of corporate or business tax. A profit-making business can deduct ordinary and necessary expenses. If I set aside a reserve, however, within my business, keep it within my business, I cannot deduct that. In fact, the IRS might come back and tell me that I've reserved too much. I've got an accumulated earnings penalty. If I make an insurance payment to a legitimate insurance company, the IRS will let me deduct that payment as an ordinary and necessary business expense. Aha, that gets in your sales, or one of you say. But all you've done is created another entity. You've taken $1 million tier. Sure, you've got the deduction on the business side, or on the parent business side, but you've paid $1 million to the captive insurer. You're at the same point. You'll still have to pay taxes. You'll have to offset all the benefits. That is not the case. First of all, let me just get out of the way the state tax ramifications. We don't have a state tax on captive insurance companies. We've got an annual supervision fee. That annual supervision fee is basically $5,000. It's the greater of formula, which you'd have to get over $6 million of annual premium a year in state to get into that formula to exceed the minimum. And there's also an annual examination fee that's paid by all insurance companies of approximately $1,000, but captive insurance companies with less than $1 million in premium don't have to pay that examination fee. But let's talk about the federal tax ramifications. The captive insurance company does pay federal tax at the corporate rate. It's taxed as a C corporation, regardless of how you set it up. But it's subject to the 831B election, which I'm going to talk about. But unlike the individual taxpayers or the individual businesses, if you are an insurance company, reserves are deductible by the captive insurer. That that shields premium income to the captive. Case reserves and incurred but not reported reserves. There's an example in the footnotes of a developer who develops a project and forms a captive insurance company, and historically realizes that there's going to be some claims for construction defects against that project, so is able to set up a captive insurance company to cover those claims and to reserve to pay those claims. So you do get that deduction. You don't have to report it as income. So aside from the fact that in many businesses the corporate rate versus individual rate versus rate that the parent pays may have some advantages to you, the nature of insurance taxation allows deductions to the captive that are not allowed to the parent non-insurance company. But now for the big one. This is the one I've been waiting for. It's the 831B deduction. It's an 831B election, and this is particularly important. It's at page 17 to small business captive companies in South Dakota. If the captive insurance company receives less than 1.2 million of premium income each year, it may elect to be taxed only on its investment income. Thus, the premiums are not taxable income. There's some restrictions that you can't revoke that election once it's made, and the big thing is it does not affect the deductibility of premiums made by the parent company. So the significant advantage is that the company is able to accumulate surplus from underwriting profits free from tax. The Section 831B small business captive pays no taxes on underwriting profits. Its owners are taxed, however,